All right, everybody. Good afternoon. We're back with the weekly rebalance. Nick, how are you doing today?
I'm doing well. How about you?
Pretty good. Can't complain.
Yeah,
Before we get
weather's nice.
started, oh yeah, it is very nice. Starting to get nice here in Ohio.
Yeah,
Before we get started, I got to shout out Garrett for our new weekly rebalance
yes,
merch here. I don't think
yes.
it's available. I don't think it's available anywhere yet.
For all the
But
people lining up for it,
oh, I know that everyone in the world is lining up for this.
our
But
main weekly rebalance groupie, Garrett, made these for us.
yeah, pretty awesome. Yeah, it's interesting. April 14th, and who can't be smiling after the market the last couple days? We've retraced all of the losses from the war in Iran. And
Yep.
now, gone past that. Another 1% today. Is that
Yeah,
right?
at least, I mean, the tech index, NASDAQ's up closer to two.
Yeah, exactly. Crazy, crazy start to the year, but interesting. Yeah, the S&P is now positive 1.59% for the year. Mid cap stocks are positive 6.8 for the year. Small cap stocks positive 8.7 for the year. It's been interesting, wild ride, but we're back. Yeah, and we're gonna dive into that in a lot more detail here in a minute. But just been an interesting ride. 32 days from
Yeah,
start to finish. Um, Very interesting.
I mean, very. And I mean, I don't know about you, but yesterday when we came into work, I was fully expecting negative 2, 3% across all major indices.
Yep.
What were you thinking about that? Because I was shocked coming off of the weekend. I saw the news on Sunday. I usually, to get an idea of what the market's going to do the next day, I take a look at Coinbase and I see the crypto selling off pretty rapid, pretty meaningfully. I was expecting a pretty negative day.
I was too. I was expecting to be a pretty negative day as well. And then it was positive, positive by quite a lot. The S&P yesterday was positive 1.02%, the Nasdaq 1.23%, and actually the VIX index fell
Yeah,
by 4.3%, 4.34% yesterday, fell, which shocked me that the volatility came out, especially with the commentary over the weekend. And it's the future started the night before pretty negative and then flipped course pretty quickly.
yeah.
But
No, I
what do you,
found that really interesting.
what do you think? Are we out of the woods, or that's what the market's telling us?
I mean, it seems that way, but I mean, we don't have a definitive conclusion to this thing yet. So I feel like we might be getting a little bit ahead of ourselves. I mean, knock on wood, it seems like everything's going to go well and we're not going to have a huge surprise here. But I don't feel like we're out of the woods yet on the actual conflict itself.
Yeah.
I think we were doing a market update call this morning. I've got Bloomberg on, and they were talking about how there was a ship making a U-turn. Basically, they thought it was going to be the first one to pass through the strait with the new blockade, and it was making a U-turn. And I'm like, well, that can't be good for markets, and they continue to rally. So, I mean, I think we're through the worst of it, assuming that ships don't start sinking.
Yeah. I hope so. We'll see. I mean, I'm cautiously optimistic. I think that's the term. I've not said, I don't know. It's hard to call it to an end yet because there's certainly not a conclusion yet. But markets tend to look past that. But
Yeah,
there's still the macro picture overall remains pretty complicated. In my opinion, you've got two issues to deal with here, and some of them are pretty heavily connected to the war in Iran, the biggest one being inflation. I mean, we've still got a meaningfully higher cost for gasoline and energy prices. Now, that should reverse quickly if this really does unwind. So maybe that can go away quickly, and then we've got some, potential issues in the labor market as well. The Fed is kind of on hold, right? But again, those things the markets are starting to look past that already, and maybe they're right.
yep. Yeah, certainly has been a quick rebound. And like you said, I mean, I feel like a lot of the market is just acting off of news from Iran. we've gotten a lot of interesting data over the past few days, CPI data, PPI data, a lot of things, like you said, that are not necessarily a great sign going forward.
Right.
Potentially that the Fed's going to have to hold for longer. There's been potential talk of hike. I don't think that there's many people talking about that, but that's started to creep into the news a lot more than it was, 2 or 3 months ago. So, um, a lot of interesting data coming out on that side, but really it seems like markets are just trading the Iran conflict right now. So as soon as we're clear of this and we're into, a more normal state, quote unquote, it'll be interesting to see how the markets digest that data, because we've seen some stuff recently that's not necessarily a great sign for inflation or employment going forward. But
Yeah, agreed. Agreed. But markets do tend to look past things. And that really gets us into the research for the day. And looking at this retracement, we wanted to call back to some of a call that we had and number of recordings that we did covering the historical precedents for geopolitical events like this, and dive into that a little bit more, because markets do tend to look past a lot of these things.
yep.
So should we let's get into that here. The retracement, a month ago we talked through this, and we talked about the historical data shows that the geopolitical shocks, regional military conflicts, they definitely affect equity markets, right? But they feel more catastrophic in the moment. But if they stay regional, they don't become globally systemic issues. The drawdowns are typically pretty short-lived and fully recovered within a pretty reasonable amount of time. And I can pull up some of the stuff that I'm going to actually pull up what we did a month ago, because I think it's really, really interesting. We did this actually just about almost exactly a month ago, maybe a little bit before that. I'm going to pull this up. Here we go. This is the actual piece that we put together a month ago, or about a month ago. And we called out a couple different geopolitical shocks. The 9/11 attacks, right? One day return -5%, drawdown almost 12%, recovered in 30 days. Cuban Missile Crisis, drawdown 6.7%, recovered in 17 days. Iraq invasion of Kuwait, drawdown almost more than 17%, recovered within 190 days. Boston Marathon bombing, drawdown 3%, recovered in 14 days. So that's how we set the scale a month ago. Now, Nick, we have already covered the answer here, but 32 days later, after the attacks,
Yep.
back to flat.
Yeah.
Lines up with what we lined out here.
Yep. No, it certainly does. I mean, it fits in the pattern from what we've seen historically. Yeah, and I find it interesting. We've got the Cuban Missile Crisis on there. Potentially the next shoe to drop after Iran, and I'm not saying we're entirely past that either, but would be Cuba. Doubtful that would have the same, market impact that we saw with Iran, just due to the Strait of Hormuz having so much traffic through it. But potentially, based off of some comments that we've seen in the news here recently, could potentially be the next thing that we're discussing here.
Yeah, definitely possible. I feel like in the moment, a lot of people, we look at these things and it's hard to put into context. Well, 9/11 attacks, for example, we just had that up on the screen, recovered within 30 days. I mean, that was obviously, the issue with this is it's hard to say we're recovered, right? That's an unfair assessment. But if you're looking just at stock markets, and if you're just concerned about how stock markets are recovering, how stock markets are performing, it's fairly normal. These geopolitical shocks, these issues, these regional conflicts. I mean, here's the chart. Here the war begins at the end of February. We draw down almost 8% to the March. I think it was March 30th was the low, right? down almost 8% in the S&P. And as soon as we start to hear the turnaround news, right, the talks about the ceasefire, um, the, shortly afterwards, we're talking about a matter of a couple of weeks from the bottom, we're fully recovered and we're back to the flat baseline,
Yep. Yeah.
and that's normal.
Yep. Pretty typical for these events.
Yeah, very, very much so. However, it's very hard to remember that in the moment. And I feel
Yes.
like that's the difficulty.
It certainly is. Yeah. Yeah. It can always seem like it's going to be different this time.
Yeah,
I think that slide that you had about the recovery uh, throughout the Iran conflict is interesting. I've kind of got the complete opposite of that here. Uh, Taking a look at the energy sector performance throughout the whole Iran conflict, and it's really interesting because it's basically the complete opposite of what you were showing there. Uh, Energy is one of the things that did well throughout as the conflict was ramping up. We saw energy stocks just continue to go higher and higher. That of course makes sense because energy production is becoming more and more scarce. But basically, we saw a complete opposite of what we saw in the broader market. It rose, and then about the time where the market started to recover, energy sector started to decline, and we're basically flat now. So, back to flat is occurring at about the same time.
yeah,
uh, both positive and negative. Now, that doesn't mean to say that energy has been a bad place to be. Year to date, energy is still, I think, the top performing sector within the S&P, due to other things as well. But throughout the Iran conflict, we moved even higher. This is the energy sector performance year to date, still up 25.3%. So really good return there, better than the broader S&P by a good amount. But we were closer to 40% at the peak of this, and we're back to where we were at the beginning of the Iran conflict. So found that interesting because that's a complete opposite of what we're seeing with the broader market, since the energy sector is, relatively speaking, a small part of market weighted indices.
yeah, definitely. It's interesting. I'm just looking at some other conflicts here on my screen. I got some data on some of these because I just think it's fascinating. But um, look at I'm looking at the annualized return for different wars. Now this is longer, extended, more than just geopolitical issues, right? Geopolitical regional conflicts. But did you know the annualized return during World War II was over 20%?
I think I've seen that figure before, and that's always surprising.
Yeah. I mean, really, really shocking. The Iraq War, 10.6%. Gulf War, 10.2%. Vietnam and Korean War in the 6% range, but that's obviously following the Korean War, especially just following the World War II. It just goes to show you that a lot of times what you think is going to happen, like you were pointing out, the energy, right, is a good example. Energy shoots up and then ends up flat, right? Oil prices are still elevated though. So that should be a benefit to these companies, but the markets really do a good job of looking past that. And sometimes what you expect is you know it's hard to believe, but it doesn't come. It's not that easy. It's not that simple. Um, the when you zoom out though, it tells a totally different story than what you might think originally.
Yeah, yeah, no, no, that's a interesting thing to point out. I mean, especially with wartime, especially extended wartime, you've got a decent amount of, at least in certain parts of the market, fiscal stimulus with the government spending to keep the war going. So, at one level it makes sense, but you've also got a lot of uncertainty going on. So, um, yeah, definitely, definitely not what people typically expect when we see announcements of war, and especially these shorter conflicts that we've seen here recently. Definitely not the typical behavior. So it's
Yeah.
surprising.
Yeah, definitely a bit surprising. But again, when you look back at the context, you look back at the historical precedents for these things, it really, really does help because it, and that's why I think it's such an important thing to study history as a portfolio manager and as an advisor, because a lot of these things are just another, it's just a repeat. It's different causes, different area of the world, different, there's variations to that. But at the end of the day, there's just another one of those things happening again. And it really helps to have that historical precedence. Otherwise, you look back on these, you're going into a move like this or a market like that, and you can overreact and buy a bunch of energy stocks at the peak. How many people, potentially did something like that, right? And
Yeah.
sold their other, their other type of stocks that were plummeting, right? Well, it reverses that quickly, and it can be a, you know fatal mistake. Hopefully not too bad,
Yeah.
but I mean, it can hurt your returns if you have these knee-jerk reactions and you react to them so quickly, thinking that this is, my thought is this is scary, this is dangerous, I need to get out, and I need to change my portfolio strategy. When in reality, not the case.
Yeah. Yeah. Staying disciplined throughout this definitely paid off. For sure.
Yeah, absolutely. Oh, sounds good. Well, what other thoughts do you have on that? What other research did you find?
Really have too much else. We were coming into this just talking about how we discussed this earlier. We expected kind of a quick turnaround on this, assuming everything got resolved relatively quickly. It didn't spread out into other regions. It lines up with a lot of similar historical events. I found the energy piece interesting that we talked about earlier, but broadly speaking, that's about it. I think there's a lot to be excited about here. It's been a good couple of weeks here for the market. Saw a nice rebound really quick.
Yeah. So you're saying the purpose of this recording was just for us to pat on ourselves on the back and say we were right.
Potentially,
We refuse to call ourselves out when we're wrong, though, right?
yeah, we won't go back and do any of that stuff. But when we get it right, no, no, and I mean, in the whole scheme of things, it was a ballpark,
Yeah.
and it's not, not to say that things can deteriorate over there and we're back into a similar situation or anything like that. Um, but I think it's interesting to go through a cycle like this where you've got a lot of uncertainty going into the event, and we go back and look at historical events where we didn't have a lot of certainty there either, but we seem to identify a pattern, and so hopefully next time a little bit more comfortable with that.
Yeah, definitely. Well, if this reverses and in 2 weeks we're back down to the retesting the lows, we'll talk about something different.
Yeah, we'll talk about something else. We can talk about how going forward what that'd be like, but yeah, I don't know that I have too much else there.
Sounds good. Well, let's do some trivia then.
Let's do it.
All right. So I'm looking. I have a couple good questions for you, I believe.
All right.
All right. Number one, I'm gonna go first. I'm just
All
gonna
right.
go for it. Okay. Talking about geopolitical shocks, which single event in modern history, let's just say since the 20s, since the early 1900s, produced the largest market drawdown, as measured by the S&P 500? Just to stay domestic here.
Repeat the beginning part of that really quick. I just want to make
So
sure I'm thinking of the right
yeah,
things.
so speaking on geopolitical, regional conflicts, all the stuff that we've been talking about, which single event produced the largest market drawdown?
Okay, like localized geopolitical conflict.
What
Like
and it don't think just localized, just think
this. Okay.
event. What event um caused the largest market drawdown in the last, let's just call it, 100 years?
Last 100 years. I mean, I'm between coronavirus and the Great Financial Crisis. I have no idea if those two are the right ones, but those are the two that come to my head. I'll go with the Great Financial Crisis. Just
Think further back.
further back.
Single geopolitical conflict event.
Okay, it is a conflict event. It's just all right.
Yep.
Geopolitical conflict event, but it's kind of like a one-off.
Yeah, geopolitical shock event. Yeah, because that wasn't a fair way of phrasing that to you with the
No,
great
no, no,
financial
no, no,
crisis
no,
and
no.
everything.
Yeah, I don't know.
Major conflict in the U.S.
Major conflict within the U.S. or
happened on U.S. soil.
oh, um, oh, I guess Pearl Harbor.
Yep, exactly.
Okay, all right, fair enough.
Pearl Harbor. Yeah, that's the largest one. So Pearl Harbor attack down 20.34%. That was the drawdown.
Wow, that's something.
Mm-hmm.
That
I phrased that terribly for you. Sorry.
no, 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 no. I definitely confused myself there too. That one makes sense. Yeah.
Yep, definitely makes sense. Took 142 days to bottom and then 304 days to fully recover, which is interesting context if you think about it. Within 1 year, basically a year, 304 days, and you're fully recovered from the attacks on Pearl Harbor. That is actually hard for me to believe that type of like essentially until the terrorist attacks on 9/11, I would say was the only true attack on U.S. soil from a foreign
Yeah.
entity, and recovered within a year is a shot. I would not, if I didn't know that already, I would not guess that.
Yeah, that really is something. And then, I mean, like you were talking about how throughout World War II, the equity returns were actually pretty strong
Yeah,
as well. Definitely, definitely surprising there.
yeah, definitely.
All right. Well, I've got another kind of historical one for you. This one's not necessarily tied to anything I talked about today, but we'll we'll go with this one. Which asset class delivered positive returns during the Great Depression while U.S. equities fell nearly 90%?
Which asset class?
Yeah,
It,
and the answer I have here is a little bit more specific than just like broad asset class. It's a little bit
okay. I'm gonna guess railroads.
railroads.
Is that like along the like? Is that the along the
I would think
lines
more,
you're thinking
a
of?
little bit more broad, maybe not like sector specific within equities. It doesn't have to be within equities either. Just asset class in general. Um,
Gold?
think more like in our Adapar, the way we have things set up, asset class detailed, that
Oh,
level as opposed to asset class broad.
like large cap core or large cap growth, large cap value, that kind of thing.
Yeah, that kind of level. Just
And specifically within the US or globally?
I think this is specifically within the US.
Okay. Oh boy, in the Great Depression. I'm gonna guess. I mean, like large cap value.
I mean, potentially held up better. I'm thinking a little bit more broad. I think we're not just looking at equities. It can be anything.
Okay, no,
So
so
maybe I
like
didn't word that very well. We can talk about any kind of asset class.
okay, gotcha. Like gold.
Yes, gold could be an answer. I don't think you want to use that as your answer though.
Any type of asset class. Well, did U.S. Treasuries like core
Yeah,
bonds?
there you go. U.S. government bonds.
All right, that makes sense.
Yep.
I was thinking only equity for some reason at first. I just it took me a second to get out of equities.
No, no, no. Yeah. I mean, you think gold basically had a steady value because it was linked to the US dollar throughout the majority of that. And then I'm seeing here long term US treasuries returned between 5 and 6% annually throughout the Great Depression. So
Yeah, interesting. It's
it's a
actually
good.
not too bad, 5 and 6% annually.
No, no. I mean, I'm guessing you got flight to safety kind of at the beginning.
Yeah. Yeah, that makes sense. All right. Well, you got any other questions for me?
I've got one other one. This one, I honestly, I don't know if I could answer this. This is one of those ones where I feel like I should be able to know, tell you the answer if someone just were to ask me. But before looking this up, I doubt that I would have gotten this 100% right. So,
Okay.
full
Well, let me
disclaimer on this.
give it a shot. As I was looking through my other questions, and unfortunately, I gave them all away during the earlier conversation.
No worries.
So,
This is another one totally unrelated to what we talked about today. That's the thing. I always got to come up with something that's kind of unrelated. Otherwise, I'll give it away.
that's good.
What does NASDAQ stand for?
I don't know. I
See,
guess
I don't think I could have answered.
I
It's
never
kind of,
looked that up. Yeah, it's just what is NASDAQ? I don't know.
yeah, it's one of those things where you just talk about it, and
Yeah,
you know how it's comprised, and you know all of the like underpinnings, you know what it holds, that sort of thing, characteristics of it, but never
yeah.
bothered to look up what does NASDAQ stand for. So I was curious. It stands for National Association of Securities Dealers Automated Quotations.
Interesting. Okay. Yeah, I would never. I didn't even know it was an acronym.
I probably wouldn't have named tell you that either, somewhat embarrassingly, but now you know.
I guess that makes sense. Like the NYSE, the New York
Yeah,
Stock Exchange. It makes sense that the NASDAQ is also an acronym. I just never thought of it like that. It was just the NASDAQ.
and you really, I mean, you can do all the sorts of analysis that you want to do on it. Do it. Never would have, need to know that what it
Yep.
stands for, but now you know.
Except maybe at a trivia
Yeah,
night or
except
something.
for in a trivia question.
Funny. Awesome. Well, like I said, I gave away all my other questions, so I don't have anything else for you.
That's all good. All
Awesome.
right,
Well, should we wrap it up for the week then?
I think so.
All right. Thanks, Nick. We'll be back again next week. Same time and same place.
Thanks, everyone.
Thanks, everybody.